Our next panel is U.S. Institutional Investor Outlook. This panel is chaired by Herman Laret, the Director of Global Macro, CTA, and Multi-Strategy at Titan Advisors. He's joined on stage by Charles Van Vleet, the Assistant Treasurer and CIO of Textron Pension Plan, Timothy Barret, Associate Vice Chancellor and CIO of the Texas Tech University System, Paul Colonna, President and CIO of Lockheed Martin Investment Management Company, and Geoffrey Rubin, Senior Managing Director and Chief Investment Strategist at CPPIB. Take it away.
Thank you. Welcome everyone, and obviously hi Jeff. Good timing. So maybe we could just start by having each of the panelists just introduce themselves very briefly, and also just give us a quick idea of what you focus on mostly with respect to asset class or portfolio construction aspect of the portfolio, if you will.
I'm the CIO at Textron. Textron's an industrial manufacturing firm in Providence, Rhode Island. Make Cessna airplanes, Bell helicopters, easy-go golf carts. You have been in one of our products. And I am the CIO overseeing $12 billion worth of defined contribution, defined benefit assets globally, UK, US, and Canada.
I'm Tim Barret. I'm the CIO at Texas Tech University. We produce future leaders, no helicopters. I manage about $2 billion in assets, about $1.2 billion in an endowment structure, and the other $800 million is Tier 3 operating capital, which is just capital you don't need for the next 5 years.
Okay. And I'm Paul Colonna. I'm President and Chief Investment Officer for Lockheed Martin, also an industrial company in the defense and aerospace industry. We run $80 billion in assets from the defined benefit and defined contribution plans for the company.
Great, and it's Geoffrey Rubin. I'm the Chief Investment Strategist with the Canada Pension Plan Investment Board. We invest the assets of the Canada Pension Plan, which now amounts to about $400 billion Canadian, on behalf of all Canadian workers and retirees.
Great, thank you very much. So I'd just like to start by framing the backdrop, and just start by saying that, you know, this is a very tough environment to navigate. And you know, when we think about how well fixed income has performed and how well equities have performed, and arguably not going to perform as well going forward, maybe I can start with you, Charles, in terms of thinking about valuations and thinking about growth, thinking about demographics and things of that nature, and even throw in ESG since we just talked about it. How are you changing your investment process to deal with all these issues, including, you know, the random tweets and things of that nature?
Well, you heard from the experts this morning, certainly much smarter than I am, that timing an economic cycle is a near impossibility. So the best I can do, I think, as this gets longer in the tooth, is look for investments, which I would call an asymmetrical profile, has better downside capture than upside capture. So I have been, over the last 2 or 3 years now, arguably early, because it continues to be a robust market and economy, but trading units of S&P for units of convertible bonds, units of S&P for SPACs, units of S&P for units of consumer staple stocks, units of S&P for private credit. These are things, again, that I feel will have an asymmetrical capture. I'm still get a positive carry. An asymmetrical capture, better downside than upside. My favorite tail risk strategy right now is we're kind of perpetually long dollar-euro calls and dollar versus Aussie calls. That's a positive carry. It's a good tail strategy. It costs me it costs me nothing because it's positive carry, and I do it in the forwards market. My favorite, I think, as much as being prepared for that event, it's also important to be ready for the opportunities that will arise in the next event. I simply can't move the committee fast enough to populate a new product. So, for example, we have put a nickel into public BDCs because I know in the next event, BDCs, as you know, commonly can trade at 10, 20-point discounts. Retail indiscriminately sells. So I put in a nickel now so I can push in $1 later. If I don't have it ready, I'm just not going to be able to move fast enough. So we have seed capital with a nickel, ready to push in $1, in public BDCs. We have pushed the same thing with a nickel now for $1 later into a strategy which is focused on fallen angels. There's this cliff of triple Bs. There's a lot of people who indiscriminately sell because they haven't managed their cure language, particularly in the corporate space. So we've seed capital a strategy that will focus just on fallen angel. And so again, I think we need to look for things where you can move quickly. Secondary CLOs. We have a secondary risk retention and CLO equity. Terrific space. It will trade at significant discounts. I need to be quickly able to move capital there.
So Tim, maybe moving on to you. We chatted beforehand, and you mentioned a number of managers that you'd allocated to, and it sounds like you've allocated a fair amount of your capital to individual hedge fund managers. And I'm just curious, when when we think about negative rates and the inability of pension funds to meet some of their liabilities, has that always been something that you guys have done, or is it something that you shifted into over time, given the lack of returns and given where spreads are, and triple Bs and double Bs are trading at 389,
Right.
for example?
It has not been a recent shift. That we've been in credit probably at multiple firms. I've been in credit since 2004 when we started building on alternative credit. I would say that the shift this past couple years has been more in line with trying to find things with shorter duration and collateral backed. Just try to get a little safer. Another example of that would be we like this CLO type structure, and we have a separate account that's kind of empty with CLOs. Same idea, waiting for the dislocation that never seems to come. But we also put money into a CLO structure that does infrastructure loans, which we like a lot because we think it's a lot less volatile and has a lot less downside than traditional CLOs. We're getting about the same return. But our big push has been very similar. We're pushing a lot of money into what we call diversifying assets. So that's where we have like a trade finance platform we bought. We're probably going to sell that this year. We have vol managers, convert ARB, all those type of things. And we've moved that from like 15% of the portfolio to 20% of the portfolio this year, just kind of in preparation of whenever that last inning is.
Interesting.
And that's been a big push for us.
Thank you. So Paul, you've seen everything.
Mm-hmm.
You've worked at Freddie Mac. You've been on the GSE side. You've seen the inner workings of how 90, as you put it earlier, 99-to-1 type leverage. Obviously, what you do today is a little different. But has monetary policy and QE and asset purchases created mini bubbles that could emulate into something comparable to a 2007, 2008? And if that is your thought process, how are you structuring the portfolio to create a safety net, as it were?
Yeah, I mean, I certainly don't think we're on the path to 2007, 2008. I could be wrong, but I think clearly, when you look at asset valuations, especially in the fixed income markets, you could argue for incredibly lofty valuations, lower yields, and you do wonder what is the true expected return out of those asset classes over the a time horizon that we look at over the next 5, 10, 15 years. So for us, it does leave you in a space where, if you're thinking strategically, I think you have to think about the portfolio and stick to your strategic insights around looking at the portfolio. And for us, in a world where, look, equities aren't exactly cheap, fixed income is very rich. It's been a great year, just very tactically speaking. It's been a great year for asset allocators in terms of asset class performance across the board. But I think for us, I think you have to look at the long-term centers of gravity for your business. And for us, it's we have to we pick managers mostly. That's what we do, and you have to pick great managers. We talked some of the panels earlier this morning about private equity and returns in private equity. If you look at the quartile distributions of performance in private equity managers, they're tremendous. So finding top quartile managers in private equity, in hedge funds, in active equities is really important. We're looking to concentrate our equity portfolios and make sure that we have the right managers in the right places. I think that's very important. In hedge funds, I think we're looking for true idiosyncratic type strategies for us that can generate returns. And so I think you have to, we're not going to move an $80 billion battleship around a tactical situation. So for us, I think it's got to, you've got to lean into those kind of core principles of manager selection, concentration in active markets, the beta in your portfolios. You've just got to try to get it cheaper, or maybe even insource it, yourselves, which I think you see a lot of plans doing. So just be efficient around beta, beta management, and then lastly for us, since we're a corporate plan, it's obviously managing the risk management of the liabilities around the pension scheme. So those are the kind of the things that we've got to focus on, even in a world where you could argue that, look, 2% rates are not a place that you want to be investing long term in.
Right. So you mentioned shifting an $80 billion balance sheet around. When we think about Dodd-Frank and Volcker and the various regulations that have inhibited the banks from using their balance sheet or have reduced the amount of balance sheet that they can apply to running their business. How do you think about liquidity risk, and how have you incorporated that factor, if you will, into your risk framework?
So for us, and I may regret saying this, but liquidity is actually not something that we're extremely worried about. I mean, that's just something when my personal
You might
opinion,
regret that.
I know, exactly. I said it, and now it's out there. But I do look at it. I personally, I think most corporate plans, look, right now we've got, I think it's like 60% of our assets are tradable within a day. Yeah. It's actually something where I think you want to be a little more thoughtful around how you look at asset classes, especially when, and to take it back to the public fixed income markets, where we started the question. Those are some of the richest asset classes on the planet right now. They're liquid, but at what point can you really deploy a lot of capital at 2% return? So I actually think that of all the things that I'm worried about and I'm thinking about, liquidity is not at the top of that list. And for us, we've got a manageable process where we look, we have to make benefit payments, we have to do things over time, but it's not a day-to-day liquidity moment for us. So.
Yeah, for us, I mean, I'll just interject there. For us, it's a huge part of what we think about. Obviously, when we allocate to hedge funds, crowding is a huge issue, and obviously AUM is to the detriment of returns. So shifting to you, Jeff, and by the way, we should rename this from the U.S. institutional investor outlook to North American institutional investor outlook, since Geoffrey works for CPPIB. So as the non-U.S. investor here, we hear in manager meetings guys selling frackers to buy renewables and things of that nature. And then there are pundits on the tape talking about how equities are going to drop 25% if Warren wins the nomination. So as an outsider, how do you view the political landscape, and how are you taking precautions for an eventual Elizabeth Warren victory? And what do you think the odds of that are?
Yeah, well, gratefully we view that from afar. That's the good news. Look, this is the relentless optimism we heard this morning from some of the initial speakers makes an impression on us, and it's something we need to contend with, but we want to contend with it over the appropriate horizon, over over a length of time that's suited to our particular circumstance and our mission and the liability structure and the cash flows that we have, all of which are intentionally designed to be very long term. The situation is going to unfold here as it also unfolds around the globe, and we are very decidedly diversifying across these geographies, very decidedly diversifying across asset classes and sectors in a way that we really hope one particular event in one particular country is not going to unduly impact our overall portfolio construct and design. It's that relentless pursuit of diversification that I think for us is consistent with the kind of profile we have as a fund and the kind of horizon we have as a fund. I'd love to also just quickly chime in on the liquidity challenge, because our types of institutions, for exactly the reasons you described, Paul, we should be tremendously well positioned to monetize our liquidity position with predictable inflows and outflow constructs and protection from the kinds of runs or the kinds of redemptions that many other asset managers face. It is a darn challenge, though, to monetize that special liquidity position in the kinds of markets that we face now. There's a real concern that the illiquidity premium is positive over time. It's super positive 1 year out of 10, and it's roughly 0 9 years out of 10. And deploying that illiquidity in periods where there is not compensation for that illiquidity premium is really difficult and frustrating and challenging. And I hear all of the different strategies that these folks have talked about as, to my mind, some means of being able to monetize that inherent liquidity position that we do enjoy.
So that's an interesting point. So for example, I was talking to a mortgage salesperson last week, and they were bringing a deal to market, and the double B, was price talk was 700 in CLO, and it widened out to 800. So presumably you guys are loving that. So along those lines, when we think about levered loans and widening in spreads in here currently, student loans is a market that's ballooned over the last several years. Thinking about ETFs and thinking about private credit funds and that mismatch between the underlying securities and the liquidity of the instruments themselves. Charles, how do you think about that when you think about those products, and what do you think is the next canary in the coal mine, if at all?
Well, we know the next crisis will look nothing like the last, and that's kind of the nature of it. But we were talking specifically in our pre-calls about fixed income, illiquidity crisis. It just drives me nuts every time I read something about ETFs. A fixed income ETF, by design, it's impossible to have a liquidity run. The AP will create a redeem on a stratified basket of one bond. Yep. Of course, they're dumping illiquidity on the remainers in the fund, yep. And people will not necessarily get market when they sell. They might only get 90 cents on the dollar, but it's really a tremendously better vehicle over a mutual fund vehicle. And private credit, same thing. I know what liquidity is on my private credit. It's zero, and that's good. That's fabulous. Everybody's handcuffed in together in this structure. So I actually don't see I don't see fixed income illiquidity being the canary.
Okay. Tim?
I think there is illiquidity problems, especially if you get to emerging market debt and you start looking at the gap risk in emerging markets. You can actually push the trade around quite a bit in emerging markets. And stuff that I would argue from our managers say that, stuff that used to trade at 40s will now drop all the way to the 20s now, right? And there's just no buyers on that end. You got to really be a lot more patient and EM because of that lack of liquidity. I would also say that in our portfolio, liquidity is a much bigger issue than what it is for these guys. We don't have a machine pumping money into us every day. Ours is outflow mostly. So we have to manage that liquidity to be able to take advantage of the dislocations in the markets.
That is true, and as a pension, I have really near perfect foresight to my outflows. I mean, short of a bubonic plague, I know exactly what my cash flows are for the next 30 years.
Right.
And it is very different for you.
Yep.
So, Tim, do you like century bonds in Argentina?
I love Argentina, actually. They're the gift that keeps on giving, as one of my managers, Robert Koenigsberger, always tells me. We're deep in Venezuela, Argentina, all those emerging markets, they're in trouble.
Paul and Jeff, any canaries in the coal mine? You guys like Argentina as well?
We're not large in emerging fixed income, so no, not for us.
The long government bonds.
Yeah.
You'd agree.
Yeah, we are very enthusiastic around emerging markets as a source of productivity and growth, broadly speaking, over the, again, longer horizons. We tend to focus, about 20% of our portfolio now is in emerging markets and tends to be focused in geographies where we can build real scale. So questions around some of the smaller frontier markets that could be really interesting for other types of institutions, perhaps a little bit less so for us. The focus on China and India and Brazil and a few other LATAM focused countries is driven as much by our ability to get access to scale there as any particular thesis on the country.
So I figured having four pension experts on the panel here today, I'd love to get some insight into your thoughts on pension risk transfer, and I read a lot about pension risk transfer to insurance companies and things of that nature. Is that on the back of sort of underfunded pension funds and some of the inherent issues, and is that a looming problem if there is a large downturn in the equity market, which has obviously been a large driver of returns for pension funds.
Maybe I'll start the conversation because we've done a
Great.
few of those transactions
Okay.
at Lockheed. We did two at the end of 2018. When I think about risk management around a pension fund, I think it's just a part of the overall process of risk management. The first part of the process is you close the plan to new entrants, then you ultimately freeze the plan to everybody, and so you end the accretion of benefits, and so then you understand what your liabilities are. So that's kind of step one in the at least the U.S. corporate pension management process. Step two is you look at ways how do you manage the balance for the firm, and look, we live in a world where you don't want to be talking about your pension fund on the earnings call, the quarterly earnings call. It's not what you want to be talking about. You want to be talking about the business, how you're investing in the business, what the growth capabilities are, where the core business is heading. And so pension risk transfers are a mechanism to help you with that. And just if you dive into that market a little bit on the pension risk transfer side, a lot of that, I'll call it arbitrage, for doing those transactions, quite frankly, is wrapped up in the PBGC fees that you have to pay as an organization, which quite frankly are exorbitant, for companies to pay. And so I think pension risk transfers allows you to take down that fee structure that the company has to pay. It also allows you to give visibility around your willingness to manage the overall balance of the pension. And so there's some benefits, for you, in terms of that. It's not going to be the final solution. It's not going to be something that you can just, make your pension go away through pension risk transfers, because they get very expensive as the fee arbitrage kind of reduces itself over time. So then that gets to the third part of the risk management process, which is really around what's your asset allocation strategy? What are you thinking about within the portfolio? How do you reduce funding status volatility? How do you still earn the returns that you need to earn? And that's really, that's a lot of what a pension fund CIO is working on. It's that latter stage, but it's a part of a holistic risk management process for the pension, PRTs being a component of it.
So all Paul's comments, I think that is the environment for corporate pensions these days. But I'll just one caveat. It just drives me nuts when I see a CFO go out. Remember, my unfunded pension, we're 94% funded. So I have 6% of a contingent claim. It's a contingent claim. I see too many CFOs, in my opinion, who go out there and then they'll issue a bond. So they will harden that claim and then top up their pension. So I've taken a contingent claim and substituted it with a hardened 20-year or 30-year bond. That's just nuts. As a shareholder, and I'm a shareholder, everyone in this room is a shareholder in your personal account, it drives me crazy to see a CFO go out and borrow perfectly good capital instead of putting it to work in their operating business, their operating efficiency. Go buy something, build something, embed something. They bury it to offset a contingent claim. It drives me nuts.
You must just believe in your ability to grow that.
But that's my job. Go out and grow it.
So Geoffrey, Paul mentioned private equity. When you think about the Stop Wall Street Looting Act, is that going to alter your view in terms of the potential returns in the sector, if that's something that you guys are heavily involved in?
Yeah, so we are. I think about a quarter of our portfolio right now, so about $100 billion is in private equity, and we have significantly more in other private asset classes, including real assets and credit. And in all of those cases, we are evaluating the entire economic prospect and proposition of the investment. And that includes the return expectations, includes the premia, the risk premia they afford. It includes the entirety of the risk profile, including liquidity risk, including regulatory risk, if that's something that needs to be assessed and is on the horizon. As part of our overall portfolio construct, we obviously believe deeply in that asset class, managed both internally and with external partners. So it is something that has been and proven to have been a really important part of our overall portfolio design and risk-adjusted return performance. We'd expect it to continue to be so going forward. So we don't see anything in particular that would undermine it. But to the extent issues arise, we certainly need to be eyes wide open as to how that risk-return proposition is changing relative to everything else we have access to.
So just turning for a second to monetary policy, and negative interest rates and things of that nature. I'd love to hear your thoughts, and whoever wants to start off, take the lead. But when we think about the reversal interest rate, what are your thoughts on that? And in the U.S. specifically, can you put a number on that?
I do not have a number on that, but if it, I mean, honestly, if we reverse, I mean, just where equities are valued now based on the low rates, and you just do the dividend discount model, and you start getting rates go up, that probably does not bode super well for risk assets, right? If you truly are going to shift that way. I think the market's a little split right now. I could probably pull half this room and they'd say we're going into Japanification, and the other half would say, oh, we'll turn because fiscal stimulus will start moving the curve. I think we could easily be talking about this 4 years from now and saying what's going to happen to rates.
Well, Ray said it well this morning. He said there's only, throughout history, there's only one true way that we've reversed deflation. The natural state of capitalism, after all, is falling prices, because capitalism is defined as producing ever more goods at ever falling prices, ever better productivity. So the natural state of capitalism is falling prices, interrupted by these things. Those things are called wars. And that's what Ray said this morning. There's many types of wars. There's wars with guns and bullets. There's wars with capital. There's wars with words. There's wars with trade. And any one of those wars is an impetus to inflation. And what we need is, I'm sorry, a healthy dose of inflation. These pension obligations go away with inflation. Student debt goes away with inflation. Government debt gets forgiven it goes away with inflation. It's that secret tax. We're on our way to, we're desperately seeking inflation, and we'll find it. We have the perfect leader for it.
I feel like you guys are talking your own book now.
Inflation is great for my funded status, yes.
Yeah, I think a slight counter to that would be, it depends what kind of inflation and whether it's anchored or unanchored, whether there's an expectation around that higher level of inflation or whether it's a big surprise. We were talking with a central bank recently, and we talked about concerns around inflation getting unanchored, and they said they totally agree to the downside, which really surprised us. They were just as concerned, if not more so, about inflation getting unanchored low, as it is to the high side. Whether that suggests or implies there's going to be continued monetary and combined with fiscal stimulus to ward against that, we'll see. But I think it's the inflation, yes, if in a well anchored and predicted fashion.
So it looks like we've got about 5 minutes before. Sorry.
I was just going to say it's going to create a huge problem when you think about the pension underfunding that people were talking about earlier. If you just take a 60-40 portfolio and use the current building blocks with inflation where it is in rates, you get to about a 3%, 4% go forward return. It's not attractive, and nobody can fund their liabilities with that, which I think is pushing everybody constantly over to the edges. That's where you're going to see people get hurt, where they start stretching too far.
So heading over the edge there, then when we think about defined benefit plans, should alternatives, what are your thoughts on alternatives, and what is the industry doing to try and get that going? If that is a source of
one of the topics that we
returns.
talked about was, right, we all took Econ 101, S must go to I, savings must go to investing. There's just many channels for that to happen. It can happen through an insurance channel, a pension channel, an ETF channel, but the channel du jour that's happening from savings to investing, and money must move, it will move, or otherwise capitalism is dead. It's moving through personal directed, so individual directed accounts, whether it's 403B, 401k, and none of those are participating in a full balanced amount of alternatives, particularly private equity and hedge funds. Real estate's starting to catch on a bit. So I'm active in a lot of organizations are, how do we get personal directed assets, 403B, Ks, IRAs, to participate more in private equity? And it's tough for one of the reasons mentioned in an earlier panel, because PE is losing the public relations campaign. Elizabeth Warren and in the country at large is painting it as, well, they just steal the balance sheet and fire the workers. So it's a tough slog to paint a better picture to get private equity into these self-directed accounts.
Paul, any thoughts?
Yeah. I mean, I think the industry is changing dramatically. We talked about, we're trying to make the pension balances smaller, and quite frankly, we're trying to make the defined contribution balances larger. I mean, quite frankly, as a company, I mean, it will be the way the next generation accumulates wealth here in the United States. And, as Charles pointed out, it's self-directed too, which adds some complexities. But I think the history of the industry also adds some complexity too. I mean, the defined contribution plan was always a little bit of an add-on or a sidecar to the DB plans. Like, well, you got a DB plan, we'll set up a DC plan with a couple of stock and bond funds and index funds, and you'll be fine because you got a DB. Right. Now we've taken away the defined benefit plans, and so I think we all need to, and I know this is something we're looking at Lockheed, I think we just all need to just think about, what do we want out of these DC plans? How do we make them as appropriate and optimized as possible for the outcomes that I think the participants are going to want going forward? And if history is a guide, and certainly our investment expertise is a guide, I think alternatives should play a piece in that outcome. I mean, that's why we do it in the defined benefit plan. If you're looking at outcomes over the lifetime of a career and even post-retirement, which I think people should be doing in terms of their defined contribution plans, don't take your money out of your defined contribution plan at retirement. Keep it in. It's low fees. It's good management for people. But thinking through retirement on these plans, I think you're going to need alternatives. And I think as an industry, as Charles was mentioning, I think as an industry, I think there's space for us to think about how we get those outcomes in. How do we get private equity in? How do we get hedge funds in? How do we stop kind of the frivolous litigation that's going to occur? Because this is, at the end of the day, the impact is going to be felt on the individuals. And we talk about a lot of crises up here this morning. I mean, certainly the other crises out there is the retirement crisis. And it's a big one, and it's real. And I think we're going to need to find a way as an industry, especially within the alternatives industry, to get that type of product and those type of returns and those types of great ideas into a defined contribution platform over time.
Great. Geoffrey, maybe start with you and work towards Charles. We've got about, actually, almost running out of time. I'd love to leave some time for questions. So I know when Madison Square Gardens is full for the Knicks game, that means the economy is doing very well, because otherwise no one would ever go to see them. What is your individual favorite economic indicator for the pulse of the economy? Just very quickly. Start with you, Jeff.
Yeah, you talk about the Knicks. I was going to say something about the Raptors and the World Championship that we hold, but the Canadian economy hasn't done terribly well since that cropped up. A pulse check on the economy. You know what? Let me go last.
Okay. I'll go.
Okay, Paul.
So my favorite used to be taxi drivers. Now it's Uber, Lyft drivers. Just whenever you're in a city, and I travel, not extensively, but a bunch, and I think always getting a little check from them on how things are going locally, especially when you get out of the New York, San Francisco, type areas, LA areas. It's fascinating what you may hear.
Yep, I love that one. Sam?
Mine's boring. It's more like PMI and service indicators.
Okay.
To see how they're
So you were excited about this morning's services number coming in at 54.7. It's got to be good.
I get excited about things like that, yes.
Hey, Charles?
And equally boring, mine's the JOLTS, voluntary departures. It says everything about wage inflation. Nobody leaves their job unless they're leaving it for better money.
Yeah.
You don't have to answer.
Upon reflection, maybe it's the number of times my board asks whether or not we are ready to de-risk the portfolio. Counter indicator.
That's a good one.
So now just last question, very quickly, thinking ahead to 2020. Where are you guys shifting your capital? A lot of LPs in the room really want to know that, obviously. And what do you think is going to be the best performing asset class in 2020? Obviously, that's the same sort of question. But.
Where we're shifting, I would say when 2020 comes around, our view is that equities are probably going to take off again, and we'll be shifting a little bit more into equities. We're also maintaining a lot of those empty accounts for the crisis at the same time, and also tail hedging that increase in equities. So we're not going into equities with that much confidence just because of valuations, but we feel like there's not a lot of other places to go right now. So we'll be there on a hedged basis.
Okay. Paul?
We tactically we like the equity markets here as well. I think there's a pretty straight market higher between here and certainly call it Super Tuesday or however you want to sketch out the early part of next year, and then it may get a little more interesting. So we like the risk markets and alternatives. We're trying to figure out how do we thoughtfully de-risk our pension plan and do that in a way that that incorporates alternatives, private credit. So we'll be allocating, probably more to privates going forward on a thoughtful basis, avoiding, again, some of the rich liquid sectors, that we've previously discussed.
Thanks, Jeff.
Yeah, emerging market, local currency, fixed income is one area we're particularly focused on, both for the returns and the diversification value it brings to the portfolio.
Interesting. Charles?
So we've built up a position the last 2 or 3 years with a couple of strategies in the public equity space that my team has, when I call it my CAT portfolio. It's focused on consumer staples, chocolate, alcohol, tobacco. They are 3 government-sanctioned drugs. People will pay any price for them. I consume all 3. I will pay any price for all of them. They will have, again, that better capture ratio. They will capture less of a downside, better of the upside. They'll do well if an inflation scenario comes along. These are inelastic demand curves. So I don't know when or if this thing's going to happen. I just want to capture less of the downside and still maintain upside exposure.
Interesting, given the fact that the trade for inflation is the least positioned for trade out there.
Public equities do fine inflation up to 5%. I mean, Goldman's trafficked that research for years. And so, consumer staples, my Altria, my InBev, my Hershey's chocolate, we heard about that earlier today. These are things which I think will have some sustainability over turmoil.
Right. Well, thank you. Let's open the floor up for a couple of very quick questions. We have just under a minute left. This gentleman right there.
Quick question. Charles mentioned casually that his pension is only 6% underfunded. I'd be curious to hear the percentages of the other 3 pensions and how that differs from 2007 before the financial crisis.
Should repeat that.
Sure. The question is, Charles mentioned 6% underfunded. This gentleman would like to hear what the balance of the panelists have in that regard. Tim?
We're an endowment, so
Yeah.
no
So
funding.
we're the other
Sorry.
pension. So we're 74% funded as
74.
of the end of last year. They actually strike it. They only strike it once a year
Yep.
officially. And to be honest with you, I don't know the 2007 number, but in general, I think most pension funds have kind of. Well, it's been a little more moderated, to be honest with you. I mean, it depends on how much you're contributing, and there's a lot of factors that may go into it beyond just interest rates and and market returns. So.
Right.
We're slightly overfunded, but it's a bit of an artifact of the accounting scheme by which the CPP is assessed.
And you had a question right here?
Yes, thanks. Sort of beyond North American limited partners, could you speak a little about an idea, mix of international LPs along the strategies with you? Is there a certain percentage that you find to be value add in terms of that position?
Nobody can hear that, I'm sure.
Sure.
Can
Can we take this last question? Are we good to take this last question?
Yes.
All right. Well, I think we've actually run out of time. I apologize, but I mean,
It was a good question.
it was a good question. You want to just repeat the question one more time, sir? Okay, fine. We done?
All right.
Okay.
I'm going to do a quick answer.
You guys, nice round of applause, please.
Yeah.
Terrific. Thank you. Sorry.